Another run at 5,000, another run at history. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostic.
Welcome back.
Thank you.
Happy 5,000 day.
I know.
Like
well, hopefully it holds
exciting.
Because I printed all these hats, and I'm going to look ridiculous if we close at $49.99.
No, I think we're there. I think we're solidly there, and round numbers, we like them.
Yeah.
They mean something to somebody. I'm Alex Steele. We're kicking off to the closing bell here in the U.S. All right, let's get to where we are then. The S&P sitting right at 50.26, so we're up by 0.6%. But to Romaine's point, just doesn't mean we're going to close here. But nonetheless, we are seeing around the highs of the session. I just wanted to also get a look, though, at sort of the best performers and worst performers within the S&P. The worst is the energy index getting hit pretty hard, down by about 1.5%. And also the tech, shocker, index up by 1.5% overall. Tech also at a record. The dollar a little bit mixed today. However, it is up for a sixth straight week. We haven't seen that gain in about 5 months. So just that stronger sort of stealthy dollar continuing to climb. And we'll get to bonds in just a second, Romaine.
Yeah, such a weird moves that we've been seeing in this market. Another big week for equities and a big week for certain sectors of the market, including gambling stocks. The biggest, in fact, in 3 months, as the once unthinkable collab between casinos and those major professional sports franchises. That's being fully consummated this week with the Super Bowl 58. Roughly 68 million Americans expected to make the first ever Super Bowl in Las Vegas the most bet upon sporting event in U.S. history. At least $23 billion expected to be wagered, with about half those bets made online. Names like Wynn, Penn Entertainment, DraftKings already winning in the equity market right now, each rallying at least 5% here on the week. DraftKings up 20% to start the year. We're going to have a deeper dive into the gaming industry in just a few minutes with Chad Bynum over at Macquarie. Meanwhile, it's not a good day for travel stocks. The surprise miss that we had on earnings guidance out of Expedia, that sent those shares to their worst day since the onset of the pandemic back in March 2020. Gross bookings and room nights falling, well short of analyst estimates. And while some of the troubles are specific to Expedia, there's still a lot of concern there about a broader slowdown in the travel industry. Shares of Booking.com, TripAdvisor, Airbnb, all moving lower here on this Friday in sympathy. But let's start the show not with equities, but as Alex said, with bonds. Rates across the U.S. Treasury curve higher for a fourth straight session, with the benchmark 10-year up 16 basis points on the week as investors start to reassess whether the economy is going to actually need, Alex, all those Fed cuts. You remember all those Fed cuts that have been priced into this market.
There were 7, there were 8, now we're 3, now we're 4, maybe 50 basis points for the first one. Lots of questions there. But we're at year-to-date highs for the bond market for yields. And this is a great chart. I appreciate it's very long-term, and I stole it from Ira Jersey of Bloomberg Intelligence. But it just really shows the trend channel since the 80s, and then this nice move higher here that we've seen. Definitely the bond bull market, you could say, is definitely over. And we saw it with the auctions this week as well. With higher yields comes the demand, kind of full stop. My question that I have is, how long can the equity market stay bid? And what kind of volatility then do we see in the bond market? Like Ira Jersey saying, look, I think we just have permanently higher yields, but the band is wide between 2 and 6%. Do we see that for the 10-year? And then what does that mean for other asset classes, Romaine?
And when you look at that band, it raises a lot of questions about the volatility going forward. Kathy Jones joining us right now, kicking us off to the close, Chief Fixed Income Strategist over at the Schwab Center for Financial Research. And Kathy, I do want to start on that question about bond market volatility, because as I'm sure you know, there are a lot of different opinions here about where rates will go, where they will end the year. It seems that given the divergence of those opinions, you have to have maybe some ructions in between.
Oh, yeah, I think, Romaine, this is a bumpy road that we're on right now in the bond market. And it's going to be that way probably for quite some time. You know, we'll have periods of volatility, probably followed by some consolidation, which is, I think, where we're headed right now. As the market digests the shift in tone by the Fed, or the perceived shift in tone by the Fed that came out of that last meeting. So now that, we have to push back the start of rate cuts, and the market's dialing back the amount of rate cuts that might happen this year, we're probably moving into another range and have to consolidate for a while and digest that information.
What's driving this most right now? I know everyone is sort of looking at the Fed itself, but obviously a lot of people looking at the economic data, whatever reads you have on inflation and the job market. And you take those revisions to the CPI numbers this morning, which, quite frankly, really weren't much of a revision at all. It seems to suggest that maybe the Fed has been right all along about the pace and the trajectory of where inflation is going.
Wouldn't that be something? The Fed was right, you know, and I don't think you get a lot of people to agree to that. But I do think they have been cautious, and I think it's turning out, perhaps rightly so, in the sense that the economy has been stronger than most of us thought was possible in the face of, 500 basis points in rate hikes and quantitative tightening. It has really been resilient and bounced back numerous times. That being said, inflation's down. So that's the other, component that the Fed should be considering. And as they sit tight where they are and inflation comes down, we're seeing real rates move up, and that is an effective tightening in policy in that way. So it's a push-pull right now, which is why I think the market just doesn't quite know where to go over the next, couple of weeks, or until we get to the next Fed meeting, probably.
So, Kathy, what I also find interesting is that financial conditions, though, continue to loosen. And I hear what you're saying about real yields. And I have to wonder that at some point, when you have equity markets at these record highs, right, and you have financial conditions continuing to loosen, does the economy actually reaccelerate at this point and inflation actually pick up?
That isn't our base case, but you're right. Credit spreads are very low, and which is a little bit of a surprise because we do have defaults starting to pick up a bit, and yet credit spreads are well below average now for much of the market, and we've seen, that has been a staple of this move here, despite the ups and downs of the economy. But that being said, reaccelerating inflation really isn't our base case because we don't see that underlying momentum, that imbalance between supply and demand. We don't see that really happening. We're seeing wages cool off a bit. The overall drivers that have been holding up inflation, like rents, are coming down. Owner equivalent rents are coming down. So I don't think that we would look at reacceleration inflation, but we certainly would look at a more sturdy economy than I think most of us expected at this point in the cycle.
Right. So hence, like, the range bound, like volatility in the bond market, but like nothing crazy, just a range bound volatility. So where do you go? Where's the fair value?
Yeah, we have fair value in 10-year treasuries, just under 4%, right? 380-ish. So we're a little bit above fair value now, and we think that as the year progresses, assuming we're right that the Fed does cut 3 or 4 times this year, and inflation continues to ebb, that those yields should come down. So we find fair value across the curve, probably more in that 7 to 10 year area than in the belly of the curve, just because that's still continuing to readjust. But we've been looking at barbells or ladders or ways to kind of average in over time. We don't see a return to 5% plus on 10-year treasuries.
All right, Kathy, always great to talk to you. Need to leave it there. Kathy Jones, Chief Fixed Income Strategist over at the Schwab Center for Financial Research, helping us kick off to the close here on the last day of the week with a closer look coming up here at hedge funds and the ones that are sounding alarm bells about a new rule from the Securities and Exchange Commission here in the U.S. A closer look at the debate over the trading of treasuries.
Can't believe they don't like that rule. All right, plus you got shares of Expedia have fallen the most since the pandemic. We're going to take a look at what's driving the drop at the online travel giant, I should say.
And Super Bowl Sunday could be record-setting on several fronts. We're going to break it down from the standpoint of viewership, advertising, and of course, sports betting. All that and more coming up in just a bit. This is The Close on Bloomberg.
Pushback to the SEC's new model to track hedge funds investments is growing louder. Shocker. In an appeals brief filed late Thursday, Ken Griffin, Citadel Securities, says the new rules are a threat to privacy and civil liberties that have, quote, set off alarm bells across the political spectrum. However, the commission created this Big Brother regime without any approval, direction, or appropriation from Congress. Our next guest says the agency's attempts to fix past mistakes will likely lead to excess volatility in the bond market. Want to get more from Bloomberg opinion columnist Aaron Brown. That's typically how it goes, Aaron, right? You fix one problem in the financial world and you create another one. What's really going to happen here? Like, take me beyond the hood of what's happening.
Well, sure. I mean, this rule now is sort of an outgrowth of 2008. When after 2008, capital requirements were increased, banks were discouraged from risk-taking. The registered dealers, especially in the government bond market, this is mostly about Treasury bond market, but it actually applies to all markets, had less capital to devote to it. So liquidity started being provided by hedge funds, by proprietary trading funds, high-frequency traders outside the SEC regulatory framework. And now the SEC is coming in and saying, okay, we want all those people to register as dealers, which means higher capital requirements. It means more disclosure requirements. It means stricter rules on the trading. I'm not sure I'd go anywhere near as far as Ken Griffin did about a threat to fundamental civil liberties, but it does make liquidity harder to provide. It means we'll have less liquidity. A lot of those organizations won't register. They'll stop providing liquidity to markets. And the ones that do provide liquidity will have to charge more for it to pay the cost of the regulation.
It also raises the question, Aaron, about for those folks who maybe still want to actually be involved in this, does it push more of this, or potentially, I should say, push more of this into the shadows, if you will? I mean, won't we just sort of get a new crop of players in this market that find a way to circumvent the regulations by basically doing it from the sidelines?
Yeah, well, you're moving the shadows, let's put it that way. The people who are now in the shadows will be exposed to bright light, and so new people will, emerge in the new shadows. Some of those people in the shadows today will move farther out. So yeah, we may end up having less understanding of how liquidity is provided and less ability to regulate it. If anyone knows, it's hard to tell.
So where does the shadow move? Private lending?
Well, there are a couple things you can do if you're under 50 million in assets. So we could get some, like the small high-frequency trading shops and continue unabated. Foreign financial institutions can do it. Public mutual funds can do it. So all of these people have exemptions and can get it. But if you're a big hedge fund, if you're a big proprietary trading fund, you can't escape. You either have to register as a dealer or you have to stop providing liquidity to the market.
This raises a broader question, though, Aaron, just about kind of, the staleness, if you will, of our sort of financial regulatory regime. I mean, most of what we have today is a direct outgrowth of either the Great Depression and some of the events that led up to it. I think we've had a few changes, obviously, in the post-World War II era. That's pretty much it. I mean, right at this stage, we're basically taking those original models from decades, if not a century ago, and really trying to tweak them for the modern era. Do we need a more major overhaul, or at least a more major rethink of not just who we regulate, but as to which agencies should be responsible for it?
Well, that's half of the truth is what you said. The other half of the truth is we've had enormous change, both in financial markets and their regulation. But what you're correct about, absolutely, is that the SEC has to shoehorn these changes into rules that were written in 1934, 1940, using vague terms like routine business. This whole thing we're talking about is a redefinition of what it means to be in routine business. It would make much more sense if Congress would take this up, hear from all sides, and come up with a modern regulatory scheme that made sense. But I'm not holding my breath for that.
Okay, so now what happens? What's next?
Well, the rule is there. It goes in effect in 60 days. I don't think it will be stopped, although Ken Griffin will probably try, and some of these other complainers might go to court or ask Congress for help. If it goes in, some of these, I think it's only going to affect maybe 50 or 60 firms. I don't think we're talking about something that, affect millions of firms. So half those firms, and just at a guess, half those firms will stop providing liquidity and half will register as dealers. We'll have less liquidity. We'll have, chaotic market changes. But I don't think it's going to destroy civil liberties in the United States.
Yeah, I mean, Ken can be, let's just say, a little on the edge of hyperbole.
But hey, we're talking about it because he said that.
If we say it, put it diplomatically. First, I applaud you, Aaron, for actually reading all 200 plus pages of this. And I also applaud you for really giving a nice shout out to the driest headline that I've ever seen on the top of a regulatory filing. Aaron Brown, Bloomberg opinion columnist, a great write-up here, a closer look here at the new changes over at the SEC that's going to redefine exactly what a dealer is, Alex. And I mean, I was looking through the numbers here. I mean, Bloomberg is saying that probably initially this is going to affect about 16 companies, meaning 16 companies that aren't dealers will now have to register, maybe as many as 40-something companies, depending on whether they want to play ball or not.
Which then, okay, fine. Maybe it's not all of them. But my question always is then as we were talking about, the shadow moves. Where does the shadow go? And you can make the argument that private credit is just like, right. I understand that they're not dealers or traders or anything like that. However, in terms of oversight, in terms of where the shadow money is, are they next?
Well, the ironic thing about this, I feel like this rule is partly designed to address that. Now, it may not do it well, but I think their whole argument was that, well, you already have these sort of shadow actors, and this sort of will force some of them into the light, if you will. I think we know that's not necessarily.
Not gonna happen, but okay.
But,
sure, one can dream.
A for effort. And did you ever get those little gold stars when you were in like first grade?
I did get the gold stars.
They don't do that. Do they still do that?
They definitely do not do that.
No.
At least not in my daughter's school.
Okay.
Everyone's awesome.
Yeah, I like. All right, coming up here, we're going to take a look at PepsiCo. Not really awesome right now. Really disappointing in investors with a lighter sales forecast. This after several quarters spent passing those higher costs onto their consumers. Apparently that era is over. We're going to recap the results and give you a reason why one analyst cut his recommendation on the stock. This is The Close on Bloomberg. All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off here with Cloudflare. KeyBank lifting the price target to 132 all the way from 94 and keeping that recommendation at overweight. The analyst Thomas Blakely citing improvement across numerous metrics in Cloudflare's fourth quarter, much of which was driven by that firm's cybersecurity deal with the U.S. Commerce Department. Investors liking what they heard, those shares having their best day, at least on an intraday basis, since they went public back in 2019. Next up, let's take a look at PayPal, getting knocked down to hold from buy. This over at Argus. Now, while the analyst says there are factors driving long-term growth competition in online payments, that's putting a lot of pressure on PayPal's growth rates. His downgrade, it reflects the flat earnings prospects in his mind for the current year. Investors, at least for today, not of the same mind. Those shares rallying 5% on the day. And finally, let's take a look at PepsiCo, losing its strong buy recommendation at CFRA. This after the fourth quarter results left a lot of analysts with a sour taste. Analyst Garrett Nelson says the downgrade to buy reflects near-term concern related to slow earnings growth. And he says volumes, they're likely to remain challenged by consumer pushback to Pepsi raising prices on those products. Those shares down about 3% on the day, and those are some of our top calls. We do want to stick with Pepsi and go straight to, well, the man who wrote that note. Garrett Nelson joining us right now, senior equity analyst over at CFR Research. Once again, taking the rating down to a buy from strong buy. Garrett, give us a sense here as to whether this is really going to be a story here in 2024 about the loss of the pricing power that they had in 2023.
Thanks for having me. And we think that's going to be a big story this year. And that's why we've become more cautious on the stock. What you saw in the quarter they just reported is the top line really flattened out. In fact, the revenue was down 0.5% year over year. And on the volume side, snack food volumes were down 3%. Beverage volumes were down 2%. And what's happened in recent months is consumers have really started to push back on these price increases that they've pushed through relentlessly over the last several quarters. So it's not only consumers themselves, but also grocers. Carrefour, which is one of the largest grocers in Europe, based in France, recently pulled all PepsiCo products off the shelves due to what they're calling unacceptable price increases. So we're more cautious on the stock.
Yeah, I remember that. That was a crazy story. And I think anyone, Garrett, who's gone into the supermarket and bought and tried to buy some of these products as of late, you see the dramatic increase, or at least relative to what it was a couple of years ago. But I do wonder if it does open up an opportunity, assuming that Pepsi is willing maybe to sacrifice some profitability, if they do decide to cut prices or offer discounts or incentives in some way, can they get those volume levels back up to maybe account for any decrease in price?
They certainly can. Look, PepsiCo is a great company, but we're entering into a phase of slower growth. The earnings growth they provided, EPS of $8.15 for 2024. That represents about 7% growth, what they're forecasting over last year's level. They're just coming off a year in which their EPS growth was 14%. So you're looking at a growth rate roughly half of what it was in 2023. And so we think that justifies caution. You know, this is a dividend aristocrat. They've raised their dividend 52 years in a row now. It's yielding over 3%, but we just think we're a little more cautious on the upside in the stock here compared to the upside that we saw over the last 12 months.
I totally get earnings were disappointing, but I gotta say, for the Super Bowl, I mean, for the salty snack population, Pepsi just owns it. I mean, it's like 60% of the market. So maybe the next couple days will be different. Garrett, do we learn anything about, say, Coke through Pepsi?
Yeah, normally the beverage segment of PepsiCo provides a strong read-through for Coca-Cola. So, we have a strong buy on Coca-Cola. They'll report next week. We were encouraged that PepsiCo's beverage volumes didn't fall as much as the snack side of the business. So, we'll just see what Coca-Cola has to say. But they're two very similar companies and two very fierce competitors, of course, both dividend aristocrats and blue chip names in the consumer staples space.
Garrett, I say this jokingly, but I kind of mean it. Was there any mention of Ozempic, Wegovy, and the weight loss drugs and the fear? I was talking to the CEO of Novo Nordisk this week, and he was like, yep, I get food CEOs calling me, being like, how is this going to actually impact my business?
Yeah, we think those concerns are somewhat overblown. One thing PepsiCo's been really good at is shifting towards healthier snack and beverage products. They've gotten into the hummus space, pita chips, and also low calorie and diet sodas. They've been introducing a lot of low calorie, low sugar products, and so we think they're making the changes that need to be made to survive in the new environment.
Is there a longer-term growth story, Garrett, that you look to right now? And I mean, once we get beyond just sort of these short-term issues with pricing and, I guess, a normalization of whatever that growth would be, I mean, what becomes the longer-term growth story?
Yeah, we think the longer-term growth story is high single-digit to low double-digit annual returns. As I mentioned, the dividend is yielding over 3% here. They're a dividend aristocrat. And then, so you add that to a mid to high digit EPS growth over the long term. And I think you're looking at high single digit to low double digit type returns. But you kind of have to pick your spots where you're more bullish on the stock, which we have been over the last couple of years, and a little less bullish now. But we still like the story long term.
All right, Garrett, thanks a lot. Really appreciate it. Garrett Nelson over at CFRA. Are you a salty snack person?
No, I'm not.
Are you a sugary drink person?
No, I'm not.
Neither.
So
We're totally
I'm definitely not the demographic that Pepsi's looking for. But
no, but they had the healthier option. I do like my skinny pop.
Yeah. Yeah, I didn't say I was healthier. I just said I have different preferences.
Fair enough.
But it's nice that you're healthy, Alex.
But
thanks for rubbing it in.
Fritos dipped in everything and during wine, red wine during the Super Bowl is a thing. It is Super Bowl weekend. Excitement is mounting. We're going to hear from the Paramount CEO. This is Bloomberg.
Just about 3:30 here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. So you just got back from Vegas.
Yeah.
You realized that you should have stayed there, right?
Yeah, well, what stays in Vegas stays in Vegas. Is that the phrase?
Yeah, whatever happens in Vegas stays in Vegas.
No, I said it right.
You didn't? Are you sure?
Yeah. Sure.
Okay, whatever. The point is you didn't stay for the Super Bowl. Are you not a Super Bowl fan?
No, I am a Super Bowl fan, and like everyone else, I will actually pretend to actually watch it and enjoy it.
Pretend to watch it. That's definitely me. I'm going to try, guys. I'm really going to try so I can hold a little bit of a conversation on Monday on it. So as we mentioned, Super Bowl 58 is almost upon us. Huge day for sports fans and for food lovers and ad lovers, everybody lovers, and everyone will be watching the game across Paramount properties. Now that's CBS, Paramount Plus, Nickelodeon for the kids. And earlier today, Bloomberg technology team talked with Paramount Global CEO Bob Bakish.
It's been an incredible season for the NFL on CBS. We set the high watermark for ratings since the property returned in 1998. We set the all-time record for a divisional playoff game. And to your point, we set the high watermark for ad sales for a Super Bowl. And it's looking like on Sunday, we'll set an all-time viewing number with any luck. So it's an incredible year to be the NFL on CBS.
we're a technology show. From a technology perspective, just how much of a feat is it to be able to put this across all your properties, to be able to have SpongeBob doing his thing, whether it's on Nickelodeon, but also to be consuming it via cable or streaming?
Yeah, so the infrastructure around the Super Bowl to ensure that the world's audiences can see it is truly extraordinary. I mean, the number of cameras, remote cameras, et cetera, I think it's like 140 or something like that. And to your point, we obviously have the main feed on CBS here in the United States. We have the first ever alternate telecast of a Super Bowl on Nickelodeon, which is going to be super fun. And to your point on tech, we're actually going to do all the graphics and enhancements real time. When we did the last Nickelodeon game last year, we did that very quickly, but it wasn't real time. The tech is now allows us to do it real time, so that's super cool. And then, of course, we have it on Paramount Plus, streaming simultaneously. So yeah, a lot of infrastructure, a lot of people behind the scenes, but we're feeling great about it, and we've been doing Super Bowls longer than anyone else, so we'll get it done.
All right, Bob Bakish there, of course, leads Paramount, talking about his network. CBS's, of course, broadcasts of the Super Bowl this weekend. It's going to be big for, of course, CBS, big for the advertisers, I guess big if you're a Taylor Swift fan, but it's also going to be big for casinos. The Super Bowl is being played in Las Vegas for the first time ever, and the sports betting industry looking to score big. Shares of Boyd Gaming already hitting a 5-month high today on the back of its fourth quarter earnings. And most of the casino stocks have actually been rallying hard ahead of the big event, with expectations of about $1.5 billion in bets wagered legally just on the Super Bowl alone. Those according to data from Macquarie. And pleased to say that Chad Bynum joining us right now, senior gaming, lodging and theaters analyst over at Macquarie. And we should point out that $1.5 billion, that's just on the Super Bowl, and that's just legally. I guess we won't talk about all the illegal bets that will push that number to multiples of that. But it gets into a broader question here, Chad, about just how far the gaming industry has come in its relationship with professional sports leagues, which I'm sure you know for years really kept that at arm's length. I was just in Vegas. I just got off a plane from there. It is a full-on embrace right now of these two industries like no other I haven't ever seen.
Yeah, it's fascinating. Las Vegas used to be a do not touch subject in city for a lot of networks, a lot of leagues. And here we are with multiple professional sports teams being hosted in Las Vegas, and obviously the first event here. It's been a week-long event, right? The sports betting industry is certainly part of sports in general. After the government reduced the rules about 5 years ago and put the power back in the hands of the states, over half of the states have legalized sports betting. And as you noted, we think about 1.5 billion wagers will be wagered this weekend. And we hope that grows, because we hope there's more states in the future that legalize, because we want to get as much of the underground above ground. And we think that's positive for everybody.
What does an event like this do for momentum for the industry writ large? Obviously, we know a lot of people take an interest not only in the game, but of course, wagering on the game when you have these big events like the Super Bowl or the NCAA finals. But how much of that momentum carries over, I guess, when we get into late February, when you don't have a big sporting event, or into March and April, et cetera?
We think it does. Wynn Resorts just reported record fourth quarter results the other day. That stock's been up almost 20% year to date. That's one of our top picks. We upgraded that name in our primer for 2024. What they talked about was F1 was more for some of the true fans of the sport. But the Super Bowl includes fans, celebrities, and corporates. So the whole week has been a party, an event, meetings, different type of gatherings. We think that continues. The strength of the conference market in Vegas shows 10 to 15% increases for 2024. So we think this event, coupled with the Sphere, which was a new arena that opened up in the third quarter of 23, and is really taking the headlines and getting people to fly to Vegas just to go to a concert. Not to go to the casino floors, but to go to a concert. We think it's great for the city.
Did I see it?
Yeah.
It kept me up all night. My hotel room literally overlooked the thing, and I was like, Kramer in that Seinfeld episode with the Kenny Rogers logo sign. I just wanted James Dolan to turn that thing off, but it is remarkable, nevertheless. At least when you're awake.
Yeah, fair enough. But Chad, what I also find interesting is that how and where you can do betting and gambling. Like, say, for the Super Bowl, what's the increase from, like, last year? Mobile devices, other online games. Like, you don't just have to be in Vegas to do this stuff.
Right. So sports betting wagers were up about 50% in 2023. 35% of that was same store, and then 15% came from new states. In 2024, we'll see North Carolina, hopefully right ahead of March Madness. But again, it's legally in 38 states right now. So there are some big states like Texas and California where you still can't do it. You have to go to Vegas. You have to go to a neighboring state. But in most markets, as I mentioned, it is legal. And we think that'll get to about 80% of the country. There are some nuances and some hurdles and difficulties in certain states. But we think in 25, 26, after this presidential year, you'll see more momentum from a legislative standpoint.
And Chad, just to be clear, if I see something that I can bet on whether or not Taylor Swift cries, I don't do that, right?
We've been hearing there's not too many bets related to Taylor Swift, so these would probably be more around, your watch parties. There was a list online in terms of will Taylor Swift be shown 6 times? That's the over/under. Will she be there on time? Will she be wearing a Kelsey jersey? So there's a number of things, but according to the apps that we've checked, there's nothing that you can do on your mobile device.
Will she be shown 6 times? That sound you hear are all the CBS producers laughing, because it's probably going to be about 60 times, Chad, if we know them. Chad, great to catch up with you. Have fun this weekend, and we'll catch up a little bit later to talk about how things shook out. Chad Bynum there, Senior Gaming, Lodging, and Theaters Analyst over at Macquarie. And 6 times, I feel like 6 times maybe in like the first 10 minutes of the game.
Totally.
They're going to show her,
Especially if she has to come in late because she's flying from Japan. There'll be a moment.
And they have all these exhibits, not exhibits, just little things set up where, the fan experience zones and things like that. And let me tell you, there's cutouts of Travis and Taylor everywhere. You can take your pictures with them. And
wasn't there something you could bet on that, like, they'll get engaged if they win or something, and then they get like free wedding, or anyone named Taylor will get a free wedding or something in Vegas? I heard about that one too.
Oh,
it's
wow.
just it's an amazing phenomenon.
Yeah.
I bet you my daughter's going to care now because she loves Taylor Swift. She doesn't know anything about football.
Well, a lot of people care. In all seriousness, I had a couple of great interviews where they really talked about how many non-sports fans are going to be interested, more so than norm. Obviously, the Super Bowl always attracts non-sports fans, but they were saying this year in particular, a lot of folks who would never watch an NFL game, even the Super Bowl, are going to be tuned into this, not because they care about the players on the field, but they care about who's in the stands.
That's amazing.
Yeah.
That's amazing.
Yeah.
And then that probably also changes other things like the ads, like the snacks. Let's get my hummus and carrots, forget the Frito-Lays.
The hummus and carrots? What is this? What is this nonsense you're talking about?
The eating of the food.
Okay, we're going to take a break. I'm going to have a talk with Alex. And then when we come back, we're going to talk about a miss on gross bookings and an executive shakeup over at Expedia. A big reason why the shares are down. That's our stock of the hour. How's that for a pivot? This is The Close on Bloomberg. Welcome back. With a little more than 15 minutes until the closing bell, time to take a look at our stock of the hour, and it is Expedia. A rough day for the stock after fourth quarter gross bookings at the company missed street estimates. But the biggest surprise actually came amid changes in the C-suite. Natalie Lung joining us right now, who covers consumer apps and the gig economy for us here at Bloomberg. Expedia shares now having their worst day since the start of the pandemic on March 16th, 2020. And let's start there because the CEO who was stepping aside was brought in during the pandemic. Why is he leaving now?
So the company said he's leaving after his 4-year contract as a CEO, and he's still going to remain as vice chairman. And he said that, the transformation that he's undertaken was a bit bigger than he thought. And with the new people he's brought in over his tenure, he felt like this is a good place to leave it to the next team.
That's more of like, oops, I didn't realize it was going to be like that. So who's the new CEO and what does that mean?
Yeah, so the new CEO is Ariel Gorin. She runs the enterprise B2B business. So they kind of power the technology behind Walmart's travel booking site or American Express's website. And that division has driven a lot of the revenue growth in the recent years. And
So in addition to what's going on at the top of the company, they released numbers. They weren't necessarily bad, but they weren't good either. So gross bookings We saw softness there. We saw, I guess, the room nights also go down. But there's also an issue here with airline fares and how that affected the company. Can you explain that?
Yeah, so due to increased airline capacity, airline prices have come down a bit. And so airline bookings is a bulk of Expedia's consumer-facing business. So that's affecting them there. And they also cited some softness in the vacation rental business. Vrbo is also owned by them.
Right.
And that's why that affected some of the top line numbers a bit.
What is that? Then what do we learn for Airbnb next week then?
Yeah, so I think for the industry as a whole, when we look at the first quarter last year, it was coming out of the post-Omicron travel boom. So if we look at this year, the growth definitely will be a bit slower and moderated.
All right, Natalie, thanks a lot. Natalie Lung joining us there. What's interesting though, Romain, is that I feel like typically if the consumer is getting a little strapped, that should be good for the likes of Priceline and Expedia and Airbnb. You're still going to go places, right? So you're going to need to more customize, watch your budget. So I find that a bit confusing.
You would think so. I mean, obviously, though, I think the interesting aspect is how much revenue they're getting from basically the commission off the cost of that flight. So I guess if that cost is coming down, less commission here, it'll be interesting to see how it balances out. And I'm glad you brought up Airbnb because it's interesting to see the divergence in the stock. So you have like Booking down, TripAdvisor down, Expedia down. Does Airbnb actually maybe
benefit from that?
Yeah, benefit a little bit from that.
Also, to be fair, Expedia had a really nice run over the last, 5 months or so. So there also is that. I love Expedia. I can go down I can spend like a day on Expedia.
Do you really?
With my hummus and my carrots. You bet.
You and these carrots.
Coming up, the S&P is on track to close above 5,000 for the first time ever. Linda Dussel is joining us. This is Bloomberg.
This is the countdown to the close. Romain Bostic here alongside Alex Steele. Just about 10 minutes, Alex, until we get to the closing bells.
We're doing it. We're doing it.
And you like round numbers. So,
I do.
And you don't get more rounder than 5,000. Well, I guess you
maybe
can't
6,000.
get more rounder or 10,000.
Yeah,
but
something like
that's
that.
a long way before we get there.
It feels like we're definitely going to close above that level.
Yeah.
Digging in beneath, though, what's really interesting, we're talking about Expedia, right? The cruise guys are getting hit really hard today too, and I couldn't see any particular news out of any one of the cruise lines. But you got hotel guys, you got the cruise liners, all in that hotel index, getting hit pretty hard. Upside though, Hermes, the ADR here, 52-week high.
Yeah.
We can complain about luxury, we can complain about China not spending, but they just continue to crush.
So was this because of you and that trip you took to Italy, where you just bought up?
It is a very good question.
European luxury.
But I do not buy full price.
Yeah.
Hermes is way too expensive for me. A fake Birkin bag, that's a little bit different. And then Applied Materials, also the best performing stock on the S&P. Again, that's a peer did well, and they're getting the lift up there. But you're going to get it. The round number, 5,000.
All right. As we count down and march to these closing bells here, a deeper dive into what's moving the market, and more importantly, taking a longer-term view of where the market might go. Linda Dussel joining us right now, senior equity strategist at Federated Hermes. And Linda, we start off with this idea that the market is really right now pricing around economic conditions that, depending on your views, seem to change a lot from day to day. But the general consensus, at least right now where we stand, Linda, is that we have an economy that's holding up and probably, at least in the short term, will continue to hold up.
I agree with you completely. Anything that looks like it's slowing down is slowing down in a slower fashion. So there's just lots of good news right now out there. The economy has proven itself to be resilient all last year, and it just continues to roll into this year. So we're continuing to keep our eyes on the employment situation. And I know the Fed is too, looking at the wage numbers, still too high, but not bad. But where the interesting area is you're seeing wage hikes in the lower income cohort, and the upper income cohort starting to see lower wage situation. That's the one thing I can really come up to worry about is a recession where the wealthier people, probably mainly younger one that had a good paycheck, lose their jobs. So far, so good.
So far, so good. And we know, of course, the cycles can change depending on the circumstances. But do you have, I guess, some confidence about monetary policy decisions and the guidance that the Fed is trying to have over this economy, at least to the extent that they have control?
Well, yes, we do at Federated Hermes. Certainly our students from back in the 70s when the Fed chairman then did a poor job. And of course, Jerome Powell does not want to repeat that mistake. I think he's trying to be as transparent as possible. And I think that the doves on the Fed have been, speakers this week have been really relatively silent on whether or not they would cut interest rates. You know, if they don't cut interest rates in March, it'll be the second longest pause that they ever did. And historically, long pauses show equity markets to keep going up. So we keep our fingers crossed. Don't cut interest rates. They're fine. They're historically fine and can keep coming down, but not now, later. And that'll be okay.
And that'll be, yes, and that's why you can see the S&P at 5,000. Do you buy the S&P at 5,000? I mean, can you buy at these records, or is there the concentration risk argument?
You know what's funny is that that the month of February is supposed to be the worst month of the year during an election year, and now here we're making new highs in the market. Those who would argue that it was only the Magnificent Seven or the Magnificent Six or whatever now will not be correct anymore, because what you're seeing now is the second largest sector in the S&P. The healthcare is making new highs. So are the industrials making new highs. Mm-hmm. There are two areas of the market that nobody seems to want to touch. That is the small cap sector of the market, which we all know very well, and then the more defensive stocks. If they don't touch the defensive stocks, they're not worried about a recession. They love these big cap stocks, and that's fine. But if you are at a record divergence versus the S&P, which is what the small cap index is, and we watch that as long-term investors, you know, you might want to take a flyer on that.
I mean, the Russell did well yesterday, so there is that point. It is held above.
One day, that's the
one day,
go.
yay. But is the value argument just a waiting for Godot argument?
Well, you know, you don't necessarily know if you'll be at the lows, but I wouldn't say that for sure. I would say that particularly if you're a stock picker, and you know, we at Federated Hermes are loving this, especially in the small cap arena. You can't necessarily buy them all, but if you look at profitable small caps, you can't say that small caps in all the sectors in general, the fundamentals have gone out the window. The worst thing you could say is that small caps are an early sector play, and we're not in a recession right now. You might like that. But one can understand, with all the angst that we've had about the continuing drumbeat of higher and higher Fed funds rates, fastest ever, something definitely is going to go wrong. People would like to stay with the larger cap stocks. They're safe, they're generating lots of cash flow, perhaps fully valued, if nowhere near that of the internet bubble. But the small cap stocks en masse are cheap. I don't necessarily need to wait for the Best Buy, or all the handbags will be taken off the shelves.
I feel you.
I love it. We're going to have to start our handbag indicator here to gauge market
Right.
sentiment.
Okay.
Linda, it gets to the idea, though, too, when we talk about the sentiment in the market. And I think most people, at least based on the traditional metrics we look at, the various bull bear indicators, et cetera, does seem to be tilted to the bullish side. And I wonder if you worried at all that maybe it's too bullish, at the idea that if you don't have any contrarians out there, you don't have some balance out there, we run the risk of getting back into the risk of a bubble, let's say.
Well, it's certainly that the sentiment indicators are not at an extremely high level at all. And that's not the only level to watch to see what investors are doing. What we get information from various sources that look at flows into bonds and into stocks. And equity saw outflows every week year to date until just this last one. It's not a frothy market at all. Perhaps people are racing towards a handful of stocks still, but they're broadening out with other sectors. They're just sticking with the large caps there. My gosh, we've even seen new highs outside of the United States.
Yeah.
So that one indicator itself is not too high to worry about. And they're not yet voting with their feet that way. They continue to bring money out because we just know we're going to have a pullback.
Yeah.
Maybe we will, but I've been in this business long enough to know that you can't time those kinds of things.
Yeah, absolutely. And, you know better than anyone else. Linda, we're going to have to leave it there. Linda Dussel, Senior Equity Strategist over at Federated Hermes, helping us count down to those closing bells. Just about 2.5 minutes away here. Gains pretty much across the board with the exception of the Dow, and gains on the week also across the board. Fifth straight week for the S&P 500.
I mean, it is staggering to me. We do not want to sell this market. Like, the market does not want to go down no matter what winds up happening. It's really incredible.
We're going to have a full breakdown for you of all the market action on the day and on the week as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're counting you down to the closing bell. And here to help take us beyond the bell. It's a global simulcast with our friends Carol Masser and Tim Stenovic, a mashup of our audiences across all of our Bloomberg platforms, television, radio, originals, and our partnership with YouTube. Green across the screen on the day, Carol Masser, green across the screen on the week.
You know, what everybody wants to know is, where have you been all week? You've been all working really hard.
I've been working hard.
Just
slaving away.
I haven't
done in Vegas.
Alex, where has he? Oh, Vegas.
Hey, wait, Vegas?
Tough job.
Vegas, baby.
Someone's got to do it.
You didn't stay for the Super Bowl and you were in Vegas?
That's what I said.
Oh, I don't know. Is there something happening out there? I didn't hear.
Adele.
Yeah.
Big game. Super Bowl 58.
Was that you climbing the Sphere, Romaine?
I tried.
Did you? Yeah.
It's a little harder than it looks, though. And apparently the police.
Somebody climbed the Sphere while Romaine was gone. I didn't see the.
Right. Well, we've been keeping everybody informed and smart about the markets and everything that's going on with earnings. Because
I did watch, right? So.
What'd you think? I heard no comments.
Wow, they're really good.
You know what they say? If you don't have anything nice to say, then don't say anything at all.
I wish I had colleagues like that to work with. Oh, wait, you do.
You guys done? You guys
Yeah,
done?
I'm done. I'm done. I had to get it out of my system.
Hey, but we're going to close at a record. Isn't that exciting?
Yeah.
50-25. You were skeptical, Romaine. We are going to get there.
Guess what, Alex? We're still oversold.
Well, yeah, exactly.
Overbought.
That was Linda was saying, right? You can be oversold for a while. So it's like you're oversold, no one wants to sell. So what do you do at this moment? I find it confusing.
You buy solar stocks. That's what people are doing. Thank you, Barclays, for raising the price target on Enphase.
Yeah, I mean, while I was looking at this, I mean, if you go back and you look at the data on the terminal here, we have had bouts of very long stretches here where we've seen the broader market in bought conditions. And it gets to this idea that, as Linda was talking about, too, that this can persist, particularly if folks think that valuations need to be reevaluated to the upside. You saw that this week. You saw that on the day. It's a big part of the reason why you're looking at an S&P 500 closing above 5,000 for the first time ever, a fresh all-time high, 5,026 and change, as these numbers might adjust a bit as we wait for them to settle. That's good for a gain of about 0.6% on the day and more than 1% on the week. Fifth straight week of gains for the S&P 500. The NASDAQ composite up more than 200 points, scraping now closer towards that 16,000 level, a 1.2% gain on the day and roughly about a 2% gain on the week. The Russell 2000, that also tried to get in on the action as well, up about 1.5% on the day, 2.4% on the week. And we should point out the Dow Jones Industrial Average, that was the outlier on the day, at least, a lower by about 0.1% and just barely flatline on a 5-day basis.
Yeah, and guys, most names in the S&P 500 higher today, 303 to be exact, 199 to the downside. And Alex, just one name unchanged.
Well, taking a look at the IMAP here, it's a great function to just see sort of everything that's playing out. Shocker, tech at a record. It's that huge green spot on the upper right of your screen. In the negative, we have energy didn't hit the hardest, consumer staples not doing as well. But, we make fun of the fact that it's all tech, sure, but also consumer discretionary was doing really well. Communication services, even utilities eked out a little bit there in the green.
All right, and I'm not all technology, so I'm going to give you something a little bit different. Hermes, the ADR rallying in a big way, pretty much finishing at its high of the session, up about 5% in today's session. In fact, overseas, you saw shares of Hermes overtaking L'Oreal for the first time today, so that was kind of significant in terms of the overseas trade. But anyway, the company came out, reported strong revenue powered by the company's, I'm just looking at sales surging, at the end of last year, sales thriving amid the slowdown in demand for luxury goods. And so what's interesting is fourth quarter revenue climbing 17.5% at constant exchange rates. The company putting that out. Analysts expected a gain of about 14%. So we've been thinking about luxury, not everybody reporting the same, but it was certainly doing well at this company. AMAT, this is your number one gainer in the S&P 500 and the NASDAQ 100 today. This stock is up just about shy of 7% there. Supply chain relationships of Cisco, Applied Materials, and Deere & Company. Keep this in mind. They will all be in focus next week when they report earnings, right? When we use the supply chain function on the Bloomberg. AMAT does report on Valentine's Day. So we'll be keeping, is it Wednesday? Yeah, I think it's on Wednesday.
Wednesday.
Yeah, thank you very much. How to figure out Valentine's Day Wednesday. There's just a lot going on. And here's something else that's different. ticker is Door, Masonite International. It's a building products company. And this soared today, up about 35%. It was bought by Owens Corning, a $3.9 billion deal, $133 a share in cash. It was a 38% premium to the closing share price as of yesterday. So investors kind of buying this deal. And yeah, there you go. So something a little bit different. Not all completely tech, although AMAT, of course, was.
Okay, not everything was higher today. It actually wasn't that difficult to find some stocks making significant moves to the downside. I want to start with Expedia Group, finishing down by 17.8%. The shares plunged the most since the onset of the pandemic after the company announced a leadership transition plan. I saw you guys talking about this on BTV just a few minutes ago and provided a first quarter outlook that fell short of Wall Street expectations. Expedia gave an outlook for gross bookings and room nights booked in the current period that fell short of estimates for high single-digit growth. The company cited lower airline prices, the grounding of Boeing's fleet, the 737 MAX 9 that is, and some weakness from its vacation rental brand Vrbo, VRBO. Also, Take-Two Interactive. Shares of Take-Two Interactive fell today, finishing the day down by 8.66%. It earlier fell as much as 10%, but paired some of those losses. It was the biggest intraday decline since November of 2022. The company slashed its full-year net bookings forecast below consensus estimates. Analysts flagged softness in NBA 2K24 sales and the pushback of a planned release to next year, though they were still confident in Grand Theft Auto 6 being released in fiscal year 2025. And then speaking of the Super Bowl, we've got to talk Pepsi. Shares of Pepsi falling today. It gave a full-year forecast that fell short of analyst estimates, reported a drop in volumes in the North America Beverage and Quaker Foods unit, shares falling 3.6% today. The company's CEO said, quote, in a statement, category growth rates are normalizing as consumer behaviors largely revert to pre-pandemic norms, Alex.
So, well, I usually do my carrots and hummus kind of thing. I have heard.
Are those PepsiCo Frito-Lay carrots?
That Frito-Lays with everything. So Fritos with everything, drink it with red wine. Like that's the go-to. Yucky, but apparently that's the thing for Sunday. So I'm definitely behind that. I'm just taking a look at the bond market, guys, because we are at year-to-date highs for yields pretty much across the board. We took down like $120 billion worth of supply this week. We took it down well. The higher we move in yields, the demand is definitely still there, but it is not rocking the equity market. We can have those higher yields, and you can still have this follow-through within the S&P.
Yeah, I mean, and it's interesting to see these moves back and forth in yields as everyone sort of tries to figure out what the Fed does next. And at the end of the day, it's really not about the Fed. It is about the economy, economic conditions that, at least for right now, look like they're holding up, guys. And that kind of brings us, I think, to the big pivot here when we start to talk about consumer spending. And you were just mentioning it there. Of course, we have the Super Bowl coming up where all eyes are not only going to be on the game, but, of course, the advertising and really just the cost and, I guess, the potential economic benefits of the whole thing.
Yeah, and also those homemade nachos that my husband's going to make. Because you know what?
Homemade nachos? Hold on, pause. What?
Yeah.
What's in those?
Like he deep fries them himself?
Makes his own chili, and then we get the nachos.
That sounds pretty good.
He makes several plates of it. Yeah. It's kind of worth it. Isn't it kind of your thing? Don't you do?
Me? I bake, but I don't make nachos. That feels like a whole
Well, I mean, it doesn't make the chips. I mean,
okay, well, that's actually a good segue to what I wanted to talk about here, because even though we see things getting less expensive or prices not increasing at the same rate, tortilla chips are 38% more expensive this year. And we're also seeing other ingredients that go into nachos being more expensive than last year. Alex, queso blanco, this according to a recent story in MarketWatch, will cost nearly 19% more.
Wow. Okay, well, that makes sense.
I don't know about the ingredients for what you make this weekend, which is the hummus and carrots.
So little chickpeas, little lemon, little garlic.
Can I just tell you, the prices of chunky chili and guacamole have stabilized since last year, and salsa and burger prices have declined slightly, according to Data Assembly. So, and the biggest price decrease is vanilla ice cream. That was never part of my Super Bowl menu, if you will. But anyway, the basket of Super Bowl favorites totaling $86.99 this year. That's up 4% over last year.
Yeah, I mean,
not too bad.
But well, the good thing is though, some of those prices. I mean, while they're still going up, of course, we know that growth rate has actually moderated from where it was the previous couple of years. But while you guys are sort of focused on your nachos or whatever else you're going to be eating there, I think everyone's going to be focused not on Patrick Mahomes or any of these people you see on the screen there. They're going to be focused on one person only,
Taylor Swift.
And I believe that's Travis Kelce.
Good one.
Ouch.
Good one.
Nice sliding that in there.
So yes, this is a great story because we love the Taylor Swift, and you can there's so many great stories of how you can bet when she'll be there, what time, whether or not you want to place those bets, and if it's safe to place those bets, it's a totally different thing. But just to show that her marketing ability for the NFL is like unparalleled at this point.
How grateful is the NFL How grateful is Roger Goodell?
She saved the game, right?
That Taylor
Well, hold on,
Swift
guys.
is
People were still going to watch the
ascend-
Super Bowl even if she wasn't there.
Yeah, but how many more people are going to watch the Super Bowl because she's there? I think a lot more people.
Listen, it's interesting. Listen, people are betting on it. What is it? There's a great story about Ira Boudway about like kind of the 89 different Taylor Swift bets. But if you're making that bet, keep in mind you can't do it here really in the U.S. If you're doing it, it's an outside firm, and there's probably outside the United States firm, and there's probably no oversight. So just keep that in mind.
What is Carol talking about? Carol, I know a guy in Baltimore. Just call. Seriously.
So they're not Taylor Swift
Outside the
fries.
US.
Can we do that?
What does that really
Are you
surprise me?
And you're from Jersey. You probably don't even need to go to Baltimore. I know some guys in South Jersey that'll hook you up too.
I'm a Northern Jersey girl. What can I tell you?
You got to drive a little if you want the real stuff. Yeah.
All right, guys. Kansas City or 49ers? Have you made a decision?
No.
I don't know. Kansas City.
All right.
For reasons.
For reasons. All right, we're going to leave it on that. That's a wrap. Our cross-platform guys, have a great weekend, a safe weekend. Our cross-platform on radio, TV, YouTube, Bloomberg Originals. We call it Beyond the Bell. We will see you again, same time, same place on Monday.
And we can continue our coverage right here on Bloomberg Television. Coming up here, a conversation with the co-founder over at Integrum Holdings. It's a social impact private equity firm, really making some big moves with some big players here. Taylor Olson, of course, formerly at KKR. He'll be joining us in just a second, right here on The Close. This is Bloomberg.
Welcome back to The Close. I'm Alex Steele with Romaine Bostick. So the conversation, now that we're at S&P 5,000, is, are we overextended or are we a further rally to go? So this is one chart that really raises that question. It's the concentration risk. It's the S&P equal weighted index, which is that white line, versus the S&P, which is that orange line. And the divergence is quite stark. In fact, we've seen 430 basis points shift just within the past 8 weeks. Now, the same thing did happen back in the first half of 2023, and it took a while, like 6 months, for the S&P to eventually fall. So that raises the question, is breadth improving? S&P equal weighted index hasn't melted down. It is hitting resistance, but it's not terrible. And this is another way to mention it. That's the percentage of S&P members that are above their 200-day moving average. It's at 70. That's, again, not terrible. And over the last 3 months, 83% of the S&P 500 companies have delivered positive returns. This is according to Bloomberg Intelligence. Gina Martin Adams with great work and her team over at BI. So that's another way to look at it. So maybe breadth isn't that bad. And one other point, as Linda Dussel was talking about, was small caps. So switch up the board and take a look at what's happening with the small cap sector. So this is the RTY, and it's 50-day moving average. You can see a nice bounce above there, but we're holding that level versus some other bounces that we've had where we've come back down. We sort of accelerated a bit too far, too fast, and then had to re-rate below the 50-day. But we're holding and we're steady, and there was no super huge breakout. So maybe we're actually improving. Healthcare, industrials, for example, also at record highs. Maybe the breadth is not so bad, Romaine.
Yeah, it'll be interesting to see how Monday shakes out coming after this record run, but we turn our attention away from the public markets and now to the private markets. Taylor Olson is joining us. He's the co-founder of Integrum Holdings. Integrum was started with former Xerox head Ursula Burns with the goal of being a business services and technology fund, but with a focus on diversity, inclusion, and social impact. Taylor, great to have you here. Just not even 3 years young so far here. Give us a sense, though, of the start of this firm, but more importantly, what has been sort of the reception that you've gotten from potential investors, and for that matter, some of the companies that you're looking to invest in?
Well, thank you for having me. It's great to be here. It's been a real whirlwind of 3 years, and it's been a lot of fun. We've been fortunate to get a lot of support from a lot of investors and companies that we've invested in large part because we brought together a team of people who've been doing this through cycle for a long period of time and really enjoy what we're doing. So
yeah, I mean, but it can't be lost on you, to start something in the middle of the pandemic, 2021, really the heart of it, to be sure. And then, of course, to try to build this out at a time where we're seeing so many changes in our economy, changes in interest rates. You had that ride up in interest rates and now maybe potentially a ride back down, depending on what the Fed does. Has that complicated things for you guys?
Well, I think starting any business, it's a little bit like assembling the airplane as it's rolling down the runway. And in our business, you also have to be selling seats on the airplane at the same time you're doing it. So it's certainly tricky, but it's if life were easy, it would be no fun. And we've had a great time doing it. Every market is complicated. Every market has risks. If it didn't, there wouldn't be opportunities for firms like ours, but we've been really fortunate to have a lot of partners who have backed us.
Where are you finding opportunities right now?
Well, what we do and where we see real opportunity, it's obviously an exciting time in general for what technology is doing within every company. And what we do fundamentally is we find great companies that historically really have been people-based businesses with great customer relationships, and we partner with management teams to invest within those businesses in technology. So we consider ourselves technology investors, but really doing it within companies that have customer relationships, that have the people, and they can really enable what they do through focused investment around innovation. And clearly the opportunity for that with the advent of all types of technology, but particularly things like generative AI is pretty exciting.
How do you get not sucked in or sucked in by AI then and find something that has a good valuation?
Well, because maybe we're old-fashioned, we believe in cash flow, we believe in EBITDA. We're finding great businesses at reasonable values. We're not looking for the lowest value, and that's not our play. But the real opportunity for us is to really invest in those companies and make them grow much more quickly and be much more valuable by harnessing technology, which creates, we think, a lot of alpha on top of just the beta that we generate through buying a good business.
I am curious, though, about the ethos around this company, this firm, I should say. We talk about the profit motive of any firm like this, but this was also a firm that was specifically designed to have much more of a social impact, with certain money going back to social impact programs, and even just the whole lineup of co-founders between you and Ursula Burns and Declan Kelly, and I'm sure I'm forgetting a couple other people. You guys, even before you got to Integrum, this idea of, I guess, doing more with money.
We're in it to make money for our investors. That's what we're tasked with doing, and that's our primary focus as a firm. But certainly we came together with a view collectively as people and as an organization that we want to do more than just that. So we set up a foundation that is part of what we do. As we do well, we contribute part of those profits to our foundation, and we can contribute back to the community, which is really great for both building culture and also building an aspect to the job that's not just about coming in and making the next dollar. But fundamentally, we set up with a vision to create value. And we've found that part of that creating value is creating the right culture, creating the right team, and creating the right unity of backgrounds and culture within that team to have a good time and to give back.
So you guys have a lot going on. Just to pare it down, what's the biggest challenge that you have right now in this environment?
It's where you spend your time. The good news is, last year, obviously, the market, deal flow environment was choppier. We were successful in finding a couple of good opportunities. We've got a busier pipeline right now than we've had in a long time. I think the market, from an activity standpoint, is catching up. But I think for an organization like us, a core tenet for how we invest and how we organize ourselves starts with focus. And we're huge believers in, if you try to do too much, you're not going to get anything done. So we spend our time prioritizing.
And just to be clear, I think I called you guys a social impact fund. The foundation is separate, right?
The foundation is separate.
So just to make that clear for our viewers, you're still there to make money.
We're in there. We're in there to make profit. And to your point, it's tough to, we want to do the right things and we want to feel good about what we do. And that's a huge part of what we do, but it is separate. Yes.
But not do too much. I feel like this is what I tell my daughter every single day at 9 years old. Don't brush your teeth and do all these things. All right, Tager, thanks a lot. We appreciate it. Come back and update us on how it's going. Tager Olson of Integrum Holdings. Thank you. All right, coming up, we're going to be talking to Greg Ebel. He is the president and CEO of Enbridge Energy. They had, it's a pipeline giant, had results earlier this morning. Lots of moving parts on this company, tons of different businesses. We're going to break it all down. This is The Close on Bloomberg. one stock to watch is Enbridge. It came out with its fourth quarter results earlier today. I can't stress this enough. This is an enormous energy company, and they do tons of stuff. They move about 30% of all the oil within North America, 20% of the natural gas within the United States. They also are working on the new hydrogen hub that the Biden administration announced for Philly. They also work a little bit in storage. They also bought Dominion to beef up its utility holdings as well. They got a lot going on. Greg Ebel is president and CEO of Enbridge, and he joins us now. Hey, Greg, it's great to see you.
Likewise, Alex.
I just want to start with the M&A portion because there's so many things we can get to this. And like I said, you had proposed to buy Dominion. It should close sometime this year. Every day I get a headline about another company, pipeline or small Permian guy or another oil company looking for a deal. Are you buying stuff?
Well, last year, 2023 was a big year for us. We did about $25 billion worth of M&A. The big one being, as you said, the Dominion gas utilities in North Carolina and Utah and in Ohio. Those are really exciting. That'll make us the largest gas utility in the United States. We picked up some renewable assets. So we've got to get those in the house this year. I expect that to happen throughout the year. We're always looking at some tuck-ins. We also sell some assets every year, too, to help finance some of that growth. So I think M&A will stay active. But for us, it's probably going to be more about let's get the tuck-ins done. Let's get the let's integrate the assets that we just bought. And we've got $25 billion backlog of just organic projects. So one thing we know, Alex, right? We're not using any less energy, and we need all forms, and we get to play in all elements of that.
So when you're talking to your peers, you might do some tuck-ins, okay? But when do you feel like this M&A cycle in the energy industry peaks?
Well, it may be just getting to go, right? Because, let's figure out where interest rates are going to end up. As interest rates start to peak and perhaps come down, who knows exactly when that's going to be. I actually think things may ramp up at that point because, after a couple of years of tightening, you see a couple of years of easing, and people will be looking for those growth opportunities, A. B, the industry is pretty consolidated on many fronts. So M&A seems to be a way to add 1% or 2% of growth. So we may be starting. I don't know that it's actually going to ebb anytime soon. I think it might just get kicked off in a big way. You've seen the upstream folks do that, right? Both Exxon and Chevron have been doing that. So maybe we'll see that on the pipeline side and some of the utility transactions as well.
Hey, Greg, I want to get your thoughts here on just some of the regulatory issues or maybe potential regulatory issues. I mean, you're in an industry that, for better or worse, is kind of having a bit of a boom time right now. But of course, you have an administration watching over that for a variety of reasons, maybe wants to tamp that down a bit, I guess, to put it diplomatically. I am curious as to when you hear some certain proposals about maybe curbing shipment of LNG outside our borders and some of those other sort of export restrictions here, how are you planning for that? Are you taking this seriously?
Well, look, you always take these things seriously, right? These are elected officials, but I think you have to put it in context. This is an election year. People say things for different reasons. That's their role. But I think if you look, for example, at the LNG piece, right, we've got Republicans, we've got Democrats, we've got everybody from Bloomberg to other news stations, et cetera, saying this is probably not a great idea for the United States, not great from a geopolitical perspective, not great for a sustainability perspective in terms of helping those countries that might be energy disadvantaged to, having them get forced into, say, the hands of the Russians for their energy. Bad idea. So let's put that on the side a little bit as in it's probably, I don't think it'll follow through, but we'll have to see. In the meantime, a company like Enbridge, we serve 5 of the large LNG facilities on the Gulf Coast. We're building one in Canada. None of that is impacted by some of these forward-looking statements. And in fact, I think you'll see the United States double its LNG exports. So let's I think cooler heads will prevail. And, we've got a role to play outside of the United States. Plenty of gas to serve consumers here. Why shouldn't we help others?
Hey, Greg, we only have about a minute left, but I talked to Lynn Good of Duke Energy, and they're spending more money. The market didn't like it. Regardless of the why, that's a tough situation. You're regulated. You need to spend a lot of money to make all this happen. Sometimes investors don't love that. What do you say?
Well, look at, I mean, our job as CEOs, and Lynn's been doing this for a long time as well, that look, you have to look at it from the long term. What's going to create long-term value? And for a company like Enbridge, continuing to invest, making sure you're doing it with by being careful with your balance sheet. But that investment creates what we've been able to do. 29 years of consecutive growth in our dividend, which, as you know, is a critical component of earnings, and particularly as interest rates turn over, and with 18 years in a row of hitting our financial guide. So you have to try to take the noise out of the short term and make sure you're building value for the long term. And that's what we're tasked with doing, and we're doing it.
All right, Greg, that's a great place to leave it. Really appreciate you taking time for us. Greg Ebel there, he's the president and CEO over at Enbridge. All right, still ahead here on the big program. Our next up segment, we're going to tell you about a mushroom farm in Brooklyn.
Love
believe
this.
it or not. It's generating a lot of buzz out there. Maybe you can pair this up with your carrots and hummus there. But it's really on a mission, not about taste, but really to eliminate and curb food waste. We're going to talk to the CEO of that startup, Winston Wong, as part of our next up segment. That's coming up in just a bit. This is The Close on Bloomberg. Welcome back. It's time now for our next up segment. This is where we highlight the entrepreneurs, the founders, really moving the needle for our economy, our markets, and of course the technology. Today's segment is for all the foodies out there and for those that also care about having a greener future. Afterlife Mushrooms is a sustainable farm that uses food waste from partnering restaurants and repurposes it to grow its mushrooms. Here in studio with us is the co-founder and CEO of Afterlife, Winston Wong. Winston, great to see you here. That was some interesting video we were just taking a look at. I guess we're getting a feel for the process here. Give us a sense here of when we say food waste, what exactly are you taking from the restaurants?
Yeah, so 80% of a lot of the back of house restaurants are currently going into landfills. So we predominantly take waste that people don't eat, for example, lemon wedges, tomato peels, avocado pits that aren't served as a plate to customers. Yeah.
So and then you use that to grow mushrooms.
That's right.
Why'd you pick mushrooms?
So mushrooms is actually one of the best natural decomposers in the world. It can break down plastic, clean up oil spills. So when we thought about mushrooms as a great way to be able to digest the food waste and actually accelerate the time that it takes to decompose it, and then we can actually fruit from it. Yeah.
And then you sell those mushrooms in theory.
And we provide it back to the restaurants. So
yeah,
exactly.
How expensive does this become for the restaurants?
Our prices are actually pretty much similar to what they would purchase currently from any food distributors. We automate a lot of our growing process, so that allows us to be able to reduce the cost, as well as the feedstock. Because we get it from these restaurants, we actually save money by not having to buy additional raw materials.
Oh, interesting. And do you pay them for the feedstock? Do they pay you, or is it all just part of the deal?
They pay us to pick it up and to process it. It would be similar to what they would pay a regular waste management company anyways. So instead, they give it to us to be able to process it.
So I was not familiar with this business. We first met a few months ago when you were pitching this idea in order to win some additional money to help fund this. One interesting thing about this, though, is this isn't all just about food. I mean, you're producing mushrooms, but also sort of mushroom products, if you will. Where do those products end up?
Yeah, so as part of our process and our mission is to make sure that nothing goes to waste. So for example, with leftover mushrooms that we have that we can't sell, we turn it into mushroom extracts. So we're partnering with CPG companies. As you know, mushroom coffee and mushroom tea is like very popular. Yeah. So we're trying to figure out how to
She's all
repurpose
into
that.
this. All she's been talking about are the carrots that she eats all day. So
and
that sounds something like Alex
it's good for you. I mean, mushrooms has a lot of functional benefits.
It's very true.
And then what's left over, we actually turn it into a compost product as well that we could provide back to farmers and parks across New York City.
I brought up the pitch that you guys did at the event in Buffalo a few months ago. I am curious just about the process of raising money, particularly in this environment when we always talk about on the show how the free money era is over. You know, people just aren't throwing checks out there the way they were over the previous 10 years or so. Have you run into some challenges in trying to get what you need?
Yeah, I would say so, 100%. I think, especially last year, the market's a little bit more volatile. So it is harder to convince investors to take a chance on a company like ours, especially around sustainability and climate. But luckily, we're able to do we're able to work with some food and ag tech investors that very much cares about sustainability. So we are seeing an increase of climate investment, which is great for companies like ours, which is,
Would this conversation have been different 4 years ago? And would it have been easier to get money 4 years ago in terms of the conversation around climate and investing and sustainability?
I'm not sure. That's a good question. I think there'll probably be more people taking chances. At the same time, I would say climate investments are growing fast. So I think it's probably a right balance. But I would say, I mean, 4 years ago, indoor farming was super hot still. So I think that probably would have been easier to get money back then.
So do you consider yourself like a ag tech? Are you a logistics business? Like you're kind of all of these things too, right? Like how do I think about you guys?
For us,
or waste management, logistics.
I think for us, we see ourselves and our mission is all about reducing food waste from going to landfills. So that is always going to be our focus. So we see ourselves as a waste management company, and mushrooms is a part of that and the first product to come out of it.
And you see momentum though going there. I'm glad you bring that up because not to promote our own stuff, but Bloomberg Originals just released a great docu-series which is all about kind of an optimist guide to the planet, basically saving the planet and creating more sustainability. And they focus a lot on communities that are either zero waste or at least trying to go towards zero waste here. When you look at those types of movements, is that still niche or has it broadened out enough where we are going to see more momentum in this space and more importantly, more money into this space?
I hope so. I mean, EPA just recently announced their new strategy around food waste reduction, and they're pumping in more grants. The government and the administration is providing more money for people to reduce food waste and reuse food waste. So I'm hoping that definitely there's going to be much more activity in this space.
Just real quick, you said mushrooms the first product. Are there more coming?
There will be. We're testing it out, experimenting in R&D around what else we can do with food waste, yes.
Okay, he's not going to tell us yet. Maybe we can come back and do that. All right, Winston, thanks a lot. Winston Wong, CEO of Afterlife Mushrooms. Do you do composting in your building? We have a huge composting in my building, too, at this point.
Well, yeah, not in our New York City apartment building, but yeah, at our home, we've been doing that for years. So, it's something I think a lot of us, even those of us who don't really consider ourselves like tree huggers, I think it's something we've all been kind of conditioned to do here.
I guess that means you're not a tree hugger?
I am, no.
You're a tree avoider.
No, but anyway, I'm a city boy, just a humble city folk here as we take a look here at quite a week, quite a day here. Markets, of course, closing out above that 5,000 level on the S&P 500. A lot more coming up here on this show, a lot more we need to cover here, including a look back on this day in history and the airplane that was said to have shrunk the globe, the Boeing 747. And we're going to leave you with a question before we go to commercial on that. What was, Alex, listen up, the unadjusted cost for a ticket in coach for the first commercial 747 flight in 1970 from New York to London?
I don't think I want to know the answer.
And we're going to give you the answer when we come back, whether Alex likes it or not. This is Bloomberg. All right, time for my favorite part of the show here, where we look back on this day in history. Back in 1969, the Boeing 747 had its first official test flight. It was an hour and 15-minute excursion above Washington State that really wowed onlookers who had really never seen anything like it. A twin-aisle airplane, more than double the size of Boeing's next largest commercial jet, 225 feet long, a cockpit 3 stories off the ground, a tailpiece 6 stories high, and a total wingspan larger than a basketball court. The cargo hold, big enough to hold 3,400 pieces of luggage. But it wasn't just the size. The technology underpinning the 747 was and still is revolutionary. The entire global navigation system, this is in 1969, it weighed less than a laptop computer today. The engines were fuel efficient before fuel efficiency was even a thing. And the plane will later feature the first in-flight audio channels that are now standard everywhere. But it was that 6,000-mile flying range and 400-seat capacity that made the 747 a hit, and it would transform the entire airline industry, from the types of planes that got built to the types of airports that had to be constructed to accommodate them, and the types of passengers that could afford to fly aboard. And that brings us to our big number. What was the average cost of an economy class ticket on the first 747 passenger flight from New York to London back in 1970? The answer? $500. And if you adjust for inflation, yeah, you got it wrong, Alex, that would be the equivalent of about $4,000 in today's money. Of course, prices have come down dramatically, and the efficiency of airplanes have improved so much that after 50 years dominating the skies, the 747 grew obsolete. All told, Boeing made almost 1,600 747s over the decades, and a year ago this month delivered its final one, not for passengers, but for cargo, which most of the 747s in operation are used for today. But what it did for passenger travel will be its legacy, according to Michael Lombardi, Boeing's corporate historian. He told Bloomberg it was the plane that shrank the world, a sentiment once echoed by none other than Microsoft founder Bill Gates, who called the 747 the first World Wide Web. What he meant by that was that it lowered one of the major barriers separating the world's nations, the cost and efficiency for a person to travel from one end of the earth to the other. Alex?
Amazing. I had 3 bets. I had $8, I had $104, and I had $1,500. So I lost in every one of those buckets. But it is truly amazing what they were able to do. And then now continual jet flight and what we're able to do there too. However, we got to get it green. We've got to get it clean. And this brings us to our next segment. A new Bloomberg show is called An Optimist's Guide to the Planet. Debuted this week, and in the first episode, Nikolai Coster-Waldau takes a look at a fascinating new technology that might help us build a carbon-free future.
To be able to break down CO2 instead of having it stay in the atmosphere would be revolutionary, to say the least.
I mean, am I wrong when I say it is like you're recycling CO2?
Yeah. We actually drew kind of a simplified
this is so helpful for me.
Picture of the overall process. CO2, electricity, water coming together, catalyst coated membrane. These 3 inputs break apart and recombine on that catalyst surface to make syngas. And then that syngas is used as an input to all kinds of different existing processes to make the fuel and material end products.
To me, it's mind-blowing. Petroleum products don't just fuel our cars, planes, and factories. The carbon in them is the raw material for almost every kind of plastic, foam, and rubber. So what 12 is proposing here is to pull the carbon out of the atmosphere and to turn it into a petroleum substitute.
Well, joining us now is Kendra Kuhl, co-founder and chief technology officer of 12, the company behind this technology. Kendra, thanks for joining. So basically, you're using CO2 as a feedstock in order to make stuff like chemicals and products. There's 2 parts I have to this, sort of the front end and the back end. For the front end, how hard is it to do it? How much energy do you need? How expensive is it?
Yeah, I think one way that I think about the energy, right, is a lot of energy today comes from burning hydrocarbons, burning fossil fuels. Just simple law of thermodynamics, right? If we want to transform that carbon dioxide that comes from burning fossil fuels back into those same kinds of fuels and materials, then we need to put in as much energy as we get out and a little bit more in order to drive the thermodynamics of those processes. So there's no free energy, right? There's no perpetual motion machine. This is, kind of basic science and following all of our basic engineering principles.
So when you are able to make it economic, because one thing we've learned is we try and go to a carbon neutral or a carbon reduction environment, is that it's just really expensive. It's just really hard to get done. And tax subsidies have helped with that. The IRA is trying to help with that. Is it economic yet?
I think any brand new first-of-a-kind technology is not going to be cost competitive with conventional technologies that have been under development for over a century, right? And so where those policies that you talked about are especially helpful is in accelerating development and accelerating deployment and adoption of these types of technologies, because we desperately need them in order to mitigate climate change. I think these technologies can become cost competitive or at least cost parity with existing conventional, but it takes some work to get there.
Well, let's talk about the work. I mean, what exactly do you need, or at least, Kendra, what do you want to see, not just for 12, but also for some of your peers out there who are working on similar or at least a complementary technology?
Yeah, It was an amazing opportunity, I'd say, to be featured in the Optimist Guide for the planet. Just to be able to show what we're doing, what others are doing, that there is hope, right? There are things we can do. I think we need to continue to have, support for development from government, from investors. I think we've seen that, right? As the climate is changing around us and beginning to affect many of us economically. Yeah. I think the investment thesis becomes stronger and stronger that we will have to do things like this.
It's interesting. We talk about the program and the title itself, and I had a chance to sit down with Nikolai, and he is indeed quite the optimist. So it was really fun to watch all of you guys and your team on camera there. But it does raise the question, I think, about whether we're all sort of behind, if you will. The idea that a lot of what we're seeing with climate change, and is featured in the documentary, is really accelerating. We're seeing that in a lot of areas. And the science we know is there, but is not at scale yet. And when do we get the scale that is going to be necessary to really sort of push back on effectively what humans have actually wrought on this planet?
Yeah, I think scale is one of the biggest challenges with climate change. So the way that we're addressing that, right, is to, we walked through our lab in the video clip that you showed. We've also started building a first of its kind jet fuel production facility to make E-jet, or sustainable aviation fuel, in Moses Lake, Washington. That's a tiny, tiny plant in the world of jet fuel, but it's a first step, and we can continue to grow from there and build larger and larger plants. Those plants are expensive. And so we do, need to find the financing in order to build them and bring them down the cost curve.
I'm glad you mentioned e-fuels, because I just wanted to get a take on, if I have a plane and I want to use your product, do I have to do anything to it, change it, retrofit it, or is it just going to be an easy swap? Because that can really help with financing and end user demand and contracts.
I think that's one of the biggest advantages of 12 carbon transformation approach, is that we're transforming carbon dioxide into an input into existing manufacturing processes for materials and fuels. And so we don't have to change anything in that downstream end. We can still fly the same planes we're flying today. We can still use the same types of materials we use today, but they're made now from carbon dioxide, which makes them inherently more sustainable.
Well, in that same thing, we're focusing on the jet fuel, but in that same clip, maybe we didn't show the part of the clip. You guys showed off the foam, of course, but also I thought it was interesting, that panel that went inside, I think it was a door for a Mercedes. And you talk about the idea that at that point, only about 10% of that panel now included the technology that you're working on, but you saw a path to get to 100%.
Yeah. So I think we showed in that clip also, we're initially transforming carbon dioxide into syngas, but that's just one of the things that we can transform it into. And syngas is an input to make many things, but not every single thing. And so as we expand on the paths we can take with carbon dioxide and what we can make it into, then we can get to that 100% sustainable carbon.
All right, Kendra. Well, this is some really cool stuff, pun intended, and a great documentary by the folks over at Bloomberg Originals, and really got a chance. Glad that they had a chance to find you and your team here. Really fascinating for somebody who really doesn't understand a lot about this, but it was really illuminating to really see just the progress we're making on the scientific front. Kendra Kuhl there, co-founder, chief technology officer over at 12. And be sure to tune in to An Optimist's Guide to the Planet. You can catch it on our Bloomberg app, on Bloomberg.com, or if you like it the old-fashioned way, right here on Bloomberg Television. Alex?
Yeah.
Yeah.
So I think it's really interesting, because I think that really truly highlights sort of the problem, is that there are these really cool technologies that can happen, that you can use, that you can explore, but the scale and the money involved is not there.
That's going to be the key.
And that's where you need things like hybrids, for example, like hybrid cars, where you need maybe natural gas and then nuclear. And there needs to be this middle ground that no one can decide what that middle ground looks like, because you don't want to abandon the things that she's talking about either. And you need the innovation to go into that. But it's going to take a while for that to turn around and be profitable.
Yeah, well, at least folks are working on it here. And I encourage everyone to really watch the docuseries the Bloomberg Originals put out. I learned quite a bit here just about what we're capable of doing. The scale might not be there, but certainly there's some really smart folks out there.
It's like on the pessimist guide to the galaxy.
We're really trying to find out solutions for it. A lot more coming up here on the show. We had a busy week, maybe a potentially busier one next week with a big CPI report. We're going to catch you up for everything you need to watch next week. This is Bloomberg. A busy week for markets, particularly here in the U.S., potentially busy next week with some key economic data, including that CPI report out of the U.S. government. Anna Wong, chief U.S. economist for us at Bloomberg Economics, joining us right now to talk a little bit more about what to expect. I was taking a look at the Bloomberg estimates, Anna. It looks like the trend line of disinflation is still intact.
Yeah, in fact, today we received some major data on the annual revisions of the CPI data, and it confirms that the disinflation progress we have seen in the past 6 months is real. In fact, the CPI core services disinflation is running a bit stronger than we even thought at the time. So I think going into next week, I think that we're going to see continued progress in disinflation, and the Fed probably will have a somewhat greater confidence that the disinflation narrative is sticking.
So if you look at core services ex housing, for example, what do we expect for that? And I mean, that's been the stickier part. Is it just not going up? Would that be a win?
Yeah, I mean, in fact, today's revisions really test that whole narrative of whether housing rent is indeed as sticky as we thought, because the revisions showed that the disinflation in both owner's rent equivalent and primary rent actually came down faster than the data was showing. So I think that will certainly test that whole idea that whether housing rent is as sticky as we thought.
All right, Anna, great stuff. We'll catch up with you next week, of course, once those numbers come out. Anna Wong over at Bloomberg Economics, one of the big things that we'll be keeping an eye on next week. And there's a lot of other things going on next week as well. I mean, you talk about inflation. Have you seen Super Bowl price tickets?
No, where are they? I don't even bother.
Well, they're more than $5, $8, whatever your guess was
Sure.
on the thing. But of course, Super Bowl 1, 2 was LV 58. Look at that.
Yeah.
I paid attention.
That's good. Latin?
Sometimes.
I want a Latin award.
Yeah, Catholic school actually paid off there. Anyway, Super Bowl 58 coming up this Sunday here. Who you got?
Chiefs. Chiefs. I'll just go with them because for reasons.
All right.
But there's other stuff.
There's other stuff, including on Tuesday.
CPI on Tuesday. We were talking about that. Wednesday, 13F filings. Are you a 13Fs kind of guy?
I do. I like them. I know they're very, very backward looking, but it's always interesting to know what the big investors like Warren Buffett and Einhorn and all those other guys, and let's face it, they're mostly guys, what they actually invested in the most recent quarter.
True.
But guess what?
What?
Earnings season. It never stops.
It's
still going on, and we got a lot of good earnings coming up next week.
Yep, we got Deere, right? I love Deere. Caterpillar did a pretty good job. Also, Coke, right? After Pepsi, that's going to be kind of interesting. Marriott's going to be a big deal. Coinbase, Airbnb, it's kind of all over the place. Then we get retail the week after, so this kind of sets us up for a little break.
Well, that's what I like. You get a nice cross-section of the economy. Not just tech, not just banks or whatever. You get the whole shebang there. Thanks for joining us this week. We'll be back next week with all your markets coverage. For now, though, stick around. Balance of Power coming up with all your political news. This is Bloomberg.